So we'll go ahead and get started. Thank you everybody for coming today to kick off our series on mastering hard conversations for business owners. We're going to start with our first session on how to talk about finances, conversations with lenders and investors. And we've pulled together a panel of folks today we think can help clarify just how to talk about various things, all things funding, so to speak. With us today also is Anna Para from our Women's Business Center here in Greenville and Jerry Smith from SCORE. They're going to be doing the second and third sessions of this series, and then Erin has a fourth section of the series that she'll talk about towards the end of our presentation today. Anna, do you want to just kind of elaborate a little bit on what your session is going to be after ours today?
Sure. So I think I'm in October. The next one would be Jerry Smith with SCORE, or I know there's somebody else presenting with SCORE that one, but I'll let them talk about that. But the Women's Business Center will be hosting how to do your business plan pitch. So how to pitch your plan, your model to different people, whether that's investors, whether that's funders, whether that's just the person with you on, maybe not on the elevator, but that you meet at the coffee shop, so that you are aware and able to confidently talk about what you're doing. What we encounter a lot of times is that business owners don't have the complete confidence in themselves and their businesses. So we are going to feature some wonderful business owners who have that down, and they will be sharing their secrets and tips. And my dates have not been great lately, so I wanted to make sure that will be on Thursday, October 7th at the same time. Thank
you, Anna.
Thank you.
Jerry, you want to talk about your session?
Sure. Yeah, we're going to be presenting on September 23rd, the same time, the noon time to 1. And this one's going to be about from the sales side. So it's going to be how to talk about sales conversations with potential customers. So this will be from our sales expert, Larry Block. And yeah, it's going to be just that. It's going to be talking about those little bit sometimes intimidating first calls and face-to-face conversations with your potential customers and clients. Thanks, Earl.
All right. Thanks, Jerry.
And Earl, and our fourth one in the series is how to talk about your problems or business problems. And this would be with your business partners, your spouses, your employees, and your customers. And we will have a partnership. Chris Jefferson and Terrence Hawes, who've been in business together since about 16 or 17. They do a lot of different things, and they have certainly seen a lot. As a matter of fact, right now they're both running for Spartanburg City Council for different seats, but not against each other. We have an attorney, a business attorney, who will talk about specifically issues with talking to your employees and ways to make sure that you are not getting in trouble with what you say. And then we will also have Caroline Gaddis from the Brew in Anderson, and she will talk about how their business owners talk about their issues with the community, the Brew community, and how the community is helpful. And then potentially one other speaker on talking with spouses. And that will be the 21st of October from 12 to 1.
All right. Thank you, Erin. So as you can see, we've got quite a great lineup for you. We're happy to be kicking it off today. So we'll go ahead and get started with our program for today. I want to introduce our panelists real quick. What I'll do is I'll just pass the mic off to each panelist, and if you could, just in a sentence or two, tell us where you're from and generally what you focus on. So we'll start with Connolly.
Okay. I am the Executive Director at Appalachian Development Corporation, and we are an SBA 504 lender, and we also have revolving loan funds. So the 504 are for fixed assets such as building equipment, and those are done throughout South Carolina through our shop. And the revolving loan funds are for the upstate counties, and those are both programs are typically in participation with a lender, a lead lender on both of those.
All right, thanks. We'll get to know a little bit more about the 504 program here in just a moment. I believe Paul is having some difficulties today, so we're going to skip over Paul for now and go with Matt.
I'm here. I did make it on, Earl. I'm here.
All right. Thanks, Paul. We appreciate that. Go ahead and introduce yourself and venture south.
Okay, thanks. Apologies for all the technical problems. I decided to have them all at once, right?
That's okay.
10 minutes ago, but I made it. So I'm Paul Clark. I'm from Skegness in Lincolnshire, England originally, but I'm from Greenville now. And most immediately, I'm from Venture South, which is an angel investment group based here in Greenville, South Carolina. We invest in early stage startup companies that typically have some kind of technology underpinning them. And we're angel investors, which means we help get people together that can invest into those companies. And we sort of facilitate the matchmaking process for that to happen. We've got, 15 companies here in Greenville. We've got 82 companies in the Southeast that we've funded over the course of the last decade or so. And we love investing in risky startups. So that's what we do.
Thank you, Paul. Thanks for being with us today.
Yeah.
All right, Matt.
Hi, everyone. My name is Matt Cloutier, and I'm an SBA Business Development Officer with County Bank. My primary focus is to help small business owners get funding through the SBA 7A program. So it's kind of similar to what Conley was discussing. The two main programs are the 504 and the 7A. And here at the bank, we kind of focus on the 7A program. It's a very versatile loan program where we can help with commercial real estate purchases, business acquisition purchases, working capital, equipment. And really the way the program works is the bank does the loan, but the SBA helps take some of that risk away from the bank by providing an SBA guarantee that the government would back if the loan were to go bad. So by that partnership and be able to utilize the SBA, the bank is able to do loans for companies that maybe a little bit earlier than they typically would, but they don't have the historical performance or maybe not as much for the down payment or need a more favorable repayment term where we can go up to 10 years on non-real estate and up to 25 years on real estate purchase loans. So that's in a nutshell kind of what I do here for County Bank.
All right. And we keep Matt and Conley very busy, that's for sure. And then we've got Scott from Carolina Foothills Federal Credit Union. Scott?
Good afternoon. As Earl just said, I'm with Carolina Foothills Federal Credit Union. I'm a small business lender. Specifically, the micro business lending is under my purview here across our footprint, which is generally the 85 corridor in the Upstate. Typically focus on loans in the $5,000 to $50,000 range. That may be for equipment, business use vehicles, retail fixtures and equipment. Sometimes outfits, or a lot of it is for existing members, business members of ours, but also are looking for early stage companies that have something together that we can help out with to get them across the finish line.
Yes, and that's a gap that we very much need to address because we don't find that type of financing. We don't have a lot of options when it comes to that type of financing. So Scott's doing a great job of helping out in that arena. So great. So, all right. Well, thank you to all the panelists who have agreed to join us today. And what we'll do is we'll get into some questions that I have here for everyone. And by all means, if you have a question as the audience, drop that into the chat. Erin is monitoring the chat and she will break in with your questions as they come about. So don't be shy. We're here to answer your questions for sure. So with that, the first question I've got, we kind of did a rundown of what everybody does and the different types of lending and funding that each of you offer. And in the spirit of the series, how do we communicate with lenders and bankers? Most of our small businesses don't have any idea what 504 means or 7A or whatever. So can I get, let's start with Matt on this question. Can I get you to tell us what differentiates your core program? You mentioned the 7A program being one of your core programs from the other programs, and how would a small business owner know ask for that or to work with you on that? How do they communicate their need in such a way that they know they're asking for the right type of funding? Matt?
Yeah, it's a good question. I think the biggest thing is just not being afraid to ask questions and say, hey, here's what I'm looking for. What should I know? And usually that can kind of open up a conversation to go in the right direction. Really, my main focus at the bank is the SBA 7A program. And kind of like what I touched on earlier is that it's versatile. We can use it. We can do one loan for several different use of proceeds. So typically on your commercial loan, if you're going to buy real estate, you're going to have a commercial real estate loan. You need equipment, you do another loan for that. Then you need working capital, you have another loan for that. So typically you've got 3 loans. The real estate's maybe on a 15, 20-year repayment schedule. The equipment's on 5, and maybe your working capital is at 2 or 3 years. The beauty to the 7A program is it allows companies to do one loan, and then you roll all that into your use of proceeds, and you can have a weighted average. The benefit really is if you're doing a commercial real estate as part of it, as long as the commercial real estate proceeds are over 50% of the loan proceeds, we can term that whole loan out for up to 25 years. So that's where you see a really benefit to our program that you might not see in others, is that if there's real estate involved, now you can do a business acquisition and maybe pay that back over 20 years, where in most cases 10 is going to be your max. So I just think talking with your banker, say, hey, I know SBA has a lot of programs right now. Here's what I'm doing. What do you think would be a good fit? Then always go online and see what's out there too, and just ask other folks in the community where they've seen success, because bankers are good and they want to help you, but they kind of do get kind of stuck in their own little world and maybe don't know about other opportunities out there. So I think you do have to ask, again, with folks like Earl and other resources like SCORE, they can kind of help point you in the right direction.
Indeed. Thank you, Matt. And you mentioned several SBA programs are available. Connolly, we'll move to you next with the 504 program. Can you explain, compare, contrast 7A and 504 and why a small business owner needs to know how to communicate and find the differences between those two?
Absolutely. So whenever you're trying to find your financing, I always advise people to look at your different options. And typically that's going to be a commercial loan, a 7A, or a 504. And then put them side by side, compare which one is better for you, the applicant, versus whoever that lender may be. And then what is it that you want to do? If you're looking to buy a fixed asset, such as a building or construct a building, and you're going to be in there for some time, probably a 504 would be the way I would advise you go. Or if it's going to be a fairly large loan, I'd advise the 504. And the reason for that is when you blend the rate with the first mortgage lender with what the 7A loan is, which right now the all-in rate is 2.8% fixed for 25 years, you're getting a nice blended rate of about 3.5, 3.75 on the commercial loan. You're talking about home mortgage rates almost there. So that's money back in your pocket versus interest to someone else's pocket. And that's kind of what I would suggest doing. But always think about where you want to be down the road, what's going to be best for you. Sometimes, and you can blend a 7A for working capital with a 504 for the fixed asset portion. So either one of those is going to be what's best for you as a business owner, and make that decision going forward. If you think you're only going to be there for 2 or 3 years, you probably don't want a 504 because of the prepayment penalties that's there. That's kind of it in a nutshell, I believe.
Yeah. Well, thanks for that, Connolly. I know we're talking fairly large numbers when we talk 504 and 7A, but not all small business owners want to take on that level of debt, or maybe just don't need that level of debt. So, Scott, can you jump in and tell us, where does the micro lending fit into this mix?
Great question. You're right. I sat in your seat for a while and saw the real gap in the marketplace. A lot of people have access to personal funds, credit cards that might fill those $2,000 to $10,000, $2,000 to $20,000 needs. That 20 to 50, 20 to 75, where it's still generally speaking too small for most 7A lenders to go through their process, and it's just there weren't many options. So when the opportunity came on to kind of get this program going through the credit union, it really appealed to me to be able to have another option. Community Works has done this as well. So just another option there for folks who don't need tons of money. We're not an investor. We're not looking to throw away money or give away money, but if we can make a solid loan request, sometimes smaller loans that don't have real collateral behind it, we can do a limited unsecured lending, but a lot of it is secured by your business equipment, vehicles. Typically, we try to stay within the scope of the business for that. So it's offering 3, 4, 5, 7 year terms to make repayment affordable. For a lot of people, it's a better option than using home equity, or it's an option to using home equity or credit cards. Certainly less expensive than credit card rates, but a shorter term than typical home equity. So if you don't want to tie your personal home to the business, an early stage business, and we really aren't the source for startup lending, but we can do some of that. So it's don't want to categorically say no, but if you have a plan, if you have some outside income, or you've got some customer engagement already, some marketplace acceptance, we can see about helping to move forward from there.
Indeed, indeed. And we're hold on to that thought, because we're going to have a question here in just a few minutes on startup funding. So we'll circle back to that. So Paul, when it comes to a client who's seeking funding, and so they have these choices in the banking arena, but they know there's other things out there too. And I can't say how many times I get a person walks through the door and says, you know what, I don't want to deal with that with the banks. I want to go talk to an investor. And there are various stages of development. Can you tell us why or why not somebody would want to consider an investment, say through Venture South, as opposed to maybe a banking solution for their funding? And how does that work? How should they find you? It's easy to find a bank. How should they find you? How can they find you?
That's true. So you would come to Venture South by going to our website or chatting with me. That's the easiest part, or the various places we're listed on. You would come to me if you didn't fit the criteria that a bank or one of these bank-related programs requires you to fulfill. So if you haven't been in business long enough, you don't have a commercial real estate element, you're a real startup that just started last week, and you don't have collateral or cash flow or some of the things that some of these programs need in different combinations, then you don't have as many options as you probably want to have. And an investor might be your best bet. We have our criteria too about what we look for and what kind of companies we fund, but we have a bit more flexibility because we follow mostly our own rule book, not the SBA's or a bank's credit committee or whatever that you need to satisfy. We don't fund every company, and like Scott said, we're not also a company. We're not trying to give away money or lose it. We can't afford to do that for very long. But we are more risk tolerant and able to fund earlier stage and more companies that are more of an idea than an established cash flowing business than other places are. There are not lots of options that can say that, and so particularly in the earlier stages of a business's life, finding funding is very hard indeed. And we are unfortunately, we can't do all the fund all the companies we perhaps would like to, but we try to do a few, and those companies that impress us are the ones that we would fund.
Okay, great. So when a client is ready, they've identified the entity that they want to work with, they have to start the conversation. They have to start communicating with you what their project is about. Can you tell us, I'm going to stick with Paul on this one. Can you tell us, well, what exactly are you looking for in the form of a presentation? What are those things that you're, how prepared should this person be? How should they communicate their idea to you? And what are those things that are like deal killers? If they walk through the door and they don't have this, or they walk through the door and they say this, we're done type of things. So what am I presenting, and what can stop that conversation?
Yeah, so the big thing we look for is that somebody's done at least a little bit of homework. And that for us is look at our website and see what the things are that we fund and try to make at least a reasonable case that you fit those criteria. So if you are a restaurant, then we're not going to fund you because we don't fund restaurants. So easy red flag deal killer for us is you just don't fit what we do, and you haven't taken the 11 seconds you need to go on our website to see our criteria and figure that out. But assuming you've done that basics, then what we really want to see above anything else is your ability to tell us in a couple of sentences what you do, how you'll make money doing it, and why it's important. So we don't need a 50-page business plan. It's great if you have one, but honestly, I'm not going to read it. If you have a 20-page pitch deck, I probably am going to read most of it, but I'm only really going to read it if I like what I hear in the first couple of minutes of our conversation. And so we direct everybody, A, to our website, and B, to putting the effort into articulating what your company does or what your idea will do in 3 sentences and 25 seconds, an elevator pitch that we can get excited about. Once we're excited about it, then we will dig in more than you want us to, although perhaps not as much as a bank would, but thoroughly into your idea and get excited again. But if you don't get past that first hurdle, then we're not going to go further.
All right. So what I'm hearing is
I'm
do the homework
Earl.
and be concise with the message, right?
Yeah.
Erin, you had something?
Oh, well, yes, we do have a question that came in on the chat. And Paul, I know you said for everyone to go to the website to find out your criteria, but rather than draw everyone's attention away from our workshop right now for 11 seconds, could you just give a brief overview of the criteria?
Sure. Yeah. So the basic ones are, it's based somewhere in the Southeast, ideally in the Carolinas, because we want to work with companies close to home that we can help. That you're looking to raise somewhere between $25,000 at the very low end and maybe up to $1 million at the very high end. That you are willing to sell some of your company. So unlike lenders, we're not lending money that you'll pay back to us. We're buying a stake in your company, and you've got to be willing to do that. Otherwise, there's no deal for us to think about. Those are the main criteria. The other one is we want to find a company that can grow very quickly. So typically there's some kind of element to the business that allows that, some technology that underlies it, or some clever franchising model or business model or something that makes us think that this company could be 10 times as big as it is today in 2 years, and give us a reasonable chance of believing that that's true. So those are our basic criteria. There's a few other smaller ones, but those are the key ones.
Good, thank you, Paul.
So unlike Paul, I know Scott would just love to read a 50-page business plan for his lending. Scott, fill us in on what you look for say a microloan.
Yeah, a good question. I don't really miss the 50-page business plan. 10 or 12 PowerPoint slides is usually enough to just simply put what is it you're trying to do? Where are you at in the process? What do you need funds for? Sometimes that's one of the hardest questions for people to nail down is, and you wouldn't think it, but I get more pushback about, so what exactly do you need us to the funds for? And it's not that we have a big long list of things we want paid for. I just need to fill in blanks and get the tell your story. So a basic business plan, a Word doc, a PowerPoint slide, a long email even, just to nail down what do you do, what do you know about the industry, and typically these are 1-sentence answers. I've been in this space for 15 years. I work for someone else. It's the opportunity now. So just telling the story, being able to provide basic documentation for if it's truly is a startup business, you don't have the typical 2 tax returns showing cash flow to cover a deal, to cover new debt, but we're going to look for personal tax returns for a couple of years. If you have filed a business return already, that's really helpful. And just help us understand how do you get from where you are to profitability, ability to service debt in the next 12 to 18 months.
Yes, indeed. So the amount of paperwork that surrounds a microloan might be a little bit lighter than what we might see, say, for a 504 or a 7A. Connolly, can you elaborate maybe on some of the differences or some of the additional details, because I know there's a few more moving parts to a 504 loan than may be involved with, say, a 7A. Can you elaborate on what some additional things might be that small business owner needs to know, and how they would communicate that to you?
Sure. And what both Paul and Scott have said has been right on for what we're looking for as well. So really just want to know your story, and how does the story relate to what you want to do in the future. So you want to buy a building, how far along in the process are you? Have you found a site? Have you found a building? Have you found plans? Have you started getting your project costs together? That kind of goes with the homework stuff that was previously mentioned as well. And something that's pretty much a red flag deal killer is when somebody says, well, how much money can I get? Well, that is not a good thing to ever say to anybody you want to borrow money from, I don't think. Should have a good plan, should have done your homework. And if you haven't been in that particular industry, how are you going to make the transition? Is there a training program? If you're buying into a franchise, what they have there. But get together all your project costs and be sure you communicate that to both us and to your lender, so we're all hearing the same thing. And I'm a big proponent of being on the same page of everyone. Just as recently as today, someone had already been approved for a loan, obligated, but they forgot to tell us they wanted to renovate a warehouse on that property. How do you forget about a piece of a warehouse that's on the property whenever we've been through the project costs umpteen times? So just make sure you've got everything covered and you're upfront with what you're wanting to do, is what I was saying. Always know how much money you think it's going to cost you based upon quotes or invoices or something.
Yeah, and I know that with the SBDC, the approach that we take there is we try to ask every client every question we think that you, the lender, is going to ask them before they get to you. And yeah, we still have a few questions that we ask that we don't get full answers to, shall we say? Yeah. So that can be frustrating in our line of work. So Matt, can you elaborate a little bit on some of the answers we've gotten so far on communicating with you and some of the red flags that you look for?
I think they've done a great job of hitting all the main points. I think for me on the first, I guess there's different ways you go through the process, but on the first conversation, to me, a big red flag is when I feel like I'm trying to be sold on something. Like, I think it's just kind of, you want to build a rapport, a little bit of trust there. You can ask questions, get direct answers, versus kind of trying to, hey, convince me on the first call that this is the best business concept that's ever been invented. I'm going to make all this money. We hear that a lot, and it kind of just makes us tune out. If you ask a question, you just want a direct answer. It doesn't have to be the perfect answer, but enough to kind of keep the conversation going. I think a big thing to me is like when you get a business plan for someone that's a startup and they don't have the experience to really make this a success. Not saying they can't do it, but why are you gonna? You need to be careful about wanting to borrow $1.5 million, put your house up. So we're not always trying to kill people's dreams, but we also want them to know what they're kind of getting into. So I think a lot of it's just having trust between the borrower and the banker, and I think just realistic expectations. If it's a startup company, thinking you're going to pull off $2.5 million in revenues in year one. Might not be realistic. It's kind of like if you're going to train for a marathon, going out in your first day and running 15 miles. So I'm not saying it can't be done, but probably not the best way to get there. On our side of things, and everything's different. If someone's coming to us, they've had a business for about 4 years, they've got some historical cash flow, they're looking to buy a building so they don't have to rent anymore. There, we're not going to be as concerned about your business plan, your pitch deck, your projections. It's going to mainly be what your historical performance is. Get behind those and say, okay, this makes sense to buy a building. However, if you're a startup or you've only been in business for maybe a year and you want to buy some additional equipment, then we're going to lean a lot more on that business plan. In the first conversation, not so much want to get a 30-page business plan, but at least kind of what your idea is, why you think it's going to be successful, and a couple of pages on that kind of details that. Then a big thing is the financial side of that and having good thought out projections over the first 3 years. And you would expect to see a progression to where year one's going to start off kind of slow, kind of build in year two and get better in year three. Kind of another red flag is if in year one it looks just the same as year 2 and year 3, and everything's kind of the same. You don't see any type of progression. So those are kind of things that I've kind of noticed over the years that kind of stick out. And I think the biggest thing is just look at it as a conversation and building trust with the banker. And if you get that going, you're going to go a long way.
All right.
Good. And this is Earl. We actually had another question come in. What benefits or weight does it carry to have a decade or more of experience in the sector for a new startup?
For me, that would have a lot. I mean, that's kind of one of the first hurdles is if you don't have the experience, who are you going to be able to bring on that has it? And if you've already got it, that's a huge bonus from my standpoint.
Sure. I would add that any business ownership experience or self-employment, a piece of that is transferable to any industry. So even if you don't have a lot of experience in a specific industry, if you've at least done something on your own before, kind of view that as part of your education and maturity. So, but if when there is that much experience in the industry, that's always a plus.
Paul, Conley, you want to chime in anything additional on those?
Yeah, I would say that experience, say for instance, you're a CNC, work there as an engineer or operator, and you want to do your own thing. It's great to have that experience, but then how are you going to get customers to go with you, or how are you going to obtain new customers? What is the market for that expansion that you're taking that experience out there with you? So it's great to have the experience, but then go beyond that and expand on it as how you going to be able to support that experience with business.
Yeah, Paul, being a equity position in a business, that kind of changes that experience dynamic a little bit, I would think, because a person getting someone to come alongside in an equity position might actually be, for lack of better terms, quote unquote, buying some experience to bring into the company. Can you elaborate a little bit on how that works as an investor?
Yeah, they might. So I certainly would echo what the others have said about it being helpful to have expertise in the space and connections and potentially your own money to bring to the deal, which typically would have if you're older than if you're younger. But that doesn't mean if you don't have those things, we aren't going to fund you. You've just got to try to convince us of something slightly different, that you can do it anyway. And the way you can do it anyway is by surrounding yourself with people that do have that experience that you can learn from, or convincing us that you're the person that can disrupt what currently happens. Because you're the one bringing some innovation or some new thinking to an industry, and so you don't necessarily have to have been the person in that industry for 2 decades to see an opportunity there. So you have slightly different things you've got to try to convince us of, but it is by no means a deal killer for us, and particularly for us because the way we're structured is we have a lot of people involved in our group, so we have pretty likely people within our network that know that space really well. And if you take money from us and them, you're also buying some of their time and expertise, which may be helpful. You may not necessarily want to listen to it all, but there might be some useful advice in there that comes with that money as well. So it certainly isn't a huge handicap for us if you are a first-time entrepreneur, or you're building a business in a space that you've only just really started spending time in. But then you do have to convince us that you're really an exceptional person and able to learn really fast to be as convincing as somebody that knows that industry.
Yeah, that's good. Yes, but easy. I always tell my clients, if you're looking for a partner, if you're looking for outside investment, don't always focus on the number of zeros on the check. Focus on the experience that the individual writing the check is bringing to it, because that in most times is much more valuable than the money that they're going to bring with them. So that's great.
It certainly can be, and I will, I guess, flip that around too and say we do a lot of diligence on you as an entrepreneur, but you want to do some diligence on who you're taking money from, because when you're indebted to somebody, you need to know what those people are like. So do your research too on who will give you the money.
That's indeed correct, indeed. So let's switch gears a little bit. Oh, go ahead.
Can I jump in with a question? I think the panel did a great job talking about the experience component of qualification. Just wondering the other criteria, specifically, the amount of money, a percentage of money that the potential business owner may need to put into a deal. I'm sure that varies. And then also things like their overall personal credit score and other criteria that you feel that would just make them qualified or non-qualified. If you guys could speak to that, I'd appreciate it.
Sure. Matt, you want to go first on that one?
Sure. From an equity standpoint, in terms of cash injection on the 7A program, it's pretty much standard that 10% is the minimum. So if you've got a $1 million deal, we're looking for $100,000 down payment. The positive is we can kind of roll in all closing costs, some working capital in that too, and we got a total project amount that we need 10% of. There are some times where we might need more than that. So if it is a startup, you're probably looking at 15 to 20% at least for us to kind of get comfortable with that. And then, on the 7A program, the benefit is we're allowed to go ahead and close a loan, even if we don't have enough collateral to fully collateralize the loan. So let's say that someone's doing a business acquisition is what we do a lot of in the 7A program. And someone's buying a business for $1 million and their equipment's worth maybe $200,000, but there's no real estate. So you've got what we kind of call an $800,000 collateral airball. And in that case, we'd probably need more than that 10% minimum. We might need up to 20%. And then you also can get in this case, the seller of the business sometime to take a seller note. So that kind of helps bridge some of that collateral gap as well. So typically it's 10% is kind of the main requirement. And there was a second part of that question. I think I forgot as I was talking, Jerry.
Yeah, it was just on the potentially credit score and that kind of thing on the personal side. I'm just trying to think of things as we're talking to clients and they're looking for lending and how we can try to prepare them before they can speak to a lender to say, hey, you got to have a few of these things in order. And I appreciate it's what I was thinking, but that 10% minimum is a good guideline for us. And
Sure.
Then I'm sure there's some criteria on the personal credit, if you could speak to that.
Right. We don't have a score per se, but we're pretty big looking at the credit from our bank side of things. I think the main thing we're looking at is not a lot of 30, 60, 90 days collections, bankruptcies. Definitely, late payments recently within the past couple of years. If you have one or two late payments, 4 or 5 years ago, we kind of just want to know what the story was there, and if there's a reason, we can understand that. But we need to know the story why you did have some late payments or an issue 4 or 5 years ago. We don't have a score per se, but I think right around 700, we usually feel pretty good about. When you start getting below, 665 in there, there needs to be a pretty good explanation of what happened to kind of cause that score to go there.
Scott, I would imagine that's a little bit different with micro lending. What are you looking for there?
Yeah, different on a couple of fronts. For true, and we have a commercial lending policy. Every institution has a policy to follow. We carved out true micro loans at 15,000 and below, which give us a lot of flexibility, specifically in terms of equity and collateral. So we don't have there's no policy specific equity injection for loans of up to 15,000. So that's kind of the most flexibility we have. Doesn't mean we do crazy stuff, but there's a little bit of, some room to negotiate that as long as the deal makes sense on all other fronts. Up to 50,000 or 15 and above to 50, it's typically going to be, if it's, business vehicle, business use vehicle, it's, maybe 5 or 10% equity. If it's general equipment used, maybe 20, 25%. So there are policy guidelines for larger loans, but it's most flexible on the smaller side. The flip side of that was the credit scoring. Our institution is a CDFI, a Treasury designated community development financial institution. We're long-term commitments to serving targeted geographic areas, underserved communities. So we don't have, trying to be credit score lenders. We don't have score thresholds. I've made loans with scores that, just aren't very compelling. But the story has to be compelling and the behavior has to be compelling. So if you look at a report and there's a difference between a credit report and a credit score. So we look for, are you current on everything right now? Do you have delinquencies in the last 12 months? Is there any other outside income in the household? When an entire household depends on you rolling the dice and risking everything for a startup with no proven track record, then that takes some point of strength somewhere. So we're pretty flexible. If the credit score is weaker, then we look for more strength somewhere else. A stronger plan, more experience, a little more cash into the deal, more commitment from the borrower. So these things all kind of trade off a little bit. If the credit score is really strong, then we can back off the collateral requirements as well. So it's a balance.
All right, good to know there, Scott. Paul, I know that when people think investors, they're probably thinking, well, that's wild, wild west there. We can do whatever we want. We can make this deal anything we need it to be. And as I've noticed, we got a question in the chat that kind of goes along with this. When it comes to putting a deal together with an investor, what kind of criteria are there? The question specifically revolves around what can you expand a little bit on what stake you plan to take in a business? How does that play into it? What kind of criteria surrounds that?
Yeah, so we don't look at credit score or reports. We don't have a particular equity stake that the founders need to have in the business or a particular amount of money that they need to have in the business. You're right that you can structure whatever deal you want if you're in a room with an investor that you have that flexibility with. I will say that my life's too short to be trying to recreate brand new deal structures all the time. So we have a particular set of things that we typically look for. And if it's way outside of those, those standard items, then it probably isn't going to be a good fit for us. We're buying somewhere between 10 and 30% of the business, depending on just the situation, the valuation, where you are in the life cycle of the business and a lot of other things. We retain that ownership in the business generally for a while, but hopefully not in perpetuity. And typically the companies we're investing in don't have commercial real estate, so that isn't usually part of the deal at all. We own the business or a piece of the business until something happens. Either somebody buys our shares in the business or you buy the shares back from us for some price at some point, or most likely somebody buys your business from you, buys the whole thing, buys our shares and your shares, and we all bank a much higher amount of money than we all invested at the beginning. That's the plan from our perspective. That could be 2 years, it could be 10 years. Hopefully it's somewhere around 5, but life is complicated, so things don't always go according to plan, but that's the goal.
All right. Well, I think that answers the question we had in chat. Monique, if there was something we missed there, please either break in or add to the chat on that.
And
So,
Earl, I'm
go
sorry,
ahead,
I
Erin.
have a question. Y'all have all used some terms that some of us may not be familiar with, like an air bubble, and in a roll-up. When you're sitting in front of a potential lender or investor, how do y'all suggest that we ask questions about what does that mean? I don't understand. How, so that you don't think, oh no, well, these people don't know anything. So what do y'all suggest?
I'm happy to take the first swing at that one. So first of all, we can't stop using jargon because that's what we have to do. Some of it's useful, some of it's just because it's a sort of shorthand that we need to use to each other. And lots of people don't understand it. And I would just say it's perfectly fine to say, I don't know what that means. Explain it to me in language that actually makes sense to a normal person. And actually, I think most good investors and lenders will respect you for that, be appreciative that you want to understand everything going into the deal, but nobody's surprised later on by things not being well explained, and might actually feel a bit guilty for using that jargon themselves when they should be doing a better job of keeping things clear for you. So definitely ask it. Don't be embarrassed to ask it. There are plenty of resources out there, so you can go do some research to sort of teach yourself a bit, and hopefully, you're capable of doing some of that. But if somebody's using terminology that doesn't make sense to you in an important commercial transaction, they need to explain it to you if they want to be good partners with you.
Anybody have anything to add to that?
I think Paul did a great job explaining. I think it kind of goes back to just trust. And I think when you say, hey, I don't understand that, please go into more detail, it's going to make me as a lender trust you more that you're trying to understand what you're doing and learn and kind of grow from the process. And we try not to do the jargon, but it just, as you're talking, it does come out from time to time. And you're like, oh, maybe they didn't understand what I was saying. I'm glad you stopped me so I can elaborate on that and learn a little bit more. And that will help us going forward to say, maybe we shouldn't use that again, and we can all learn from it.
Mm-hmm.
Yep. Well said.
Okay, so we're getting close to the end of our time here, so I'm going to close out with one more question here. We've talked primarily about funding to this point, and how do we talk to you about getting money and the like, but I'm sure you guys talk to your clients about other things, right? You're hoping that they communicate with you on a more regular basis than just when they need to get some money. So let's talk about some of the other things that you would want a small business owner to come to you and talk to you about if and when they occur. I'm thinking things like, gee, I can't pay the payment, or I just added a partner, or some of these other things that might come up in business ownership. What do you need to know, and how might you want the small business owner to communicate with you on that? Connolly, we'll start with you.
Okay. I think that once you sign the papers with the lender, you've got a partnership as long as you have that loan. So it's good to communicate, keep them what's going on, because down the road, you may want to do something. And almost all lenders are going to have some type of loan covenants that you should pay attention to, things you cannot do, provide financial statements. And it's best to keep that communication lines open. This COVID we just went through is a prime example of that. When people being proactive and saying, hey, this is going to impact our business, what are some options for us if we get to that point? Not waiting until there's a crisis and there's a fire and saying we need our payments deferred for some time. And that was very helpful as we went into that. To be planning ahead for something that may or may not ever happen is just good insurance, in my opinion, as well. I think too, customers start outgrowing their business, and I have several saying, Conley, I think we're getting where we want to buy another building one day, or we want to buy another piece of equipment. What do we need to start doing now so we get there? And with both 7A programs, there's a maximum 7A outstanding that you're allowed. So it's good to know what that number is, and that's across all SBA loans, whether it's PPP, EIDL, 7A, 504, whatever it might be. There's a cap. So you want to be aware of what that cap is as you want to grow your business going forward too. And I think too, it's good for us as lenders to go out and visit our clients, let them know that we're interested in what they're doing, and stay in the forefront with them as well. But it just goes back to what I keep hearing everybody saying. It's communication across the board there, I think.
Yep. Scott, what's somebody that you've worked with, you sit back in your chair one day and say, man, I wish they'd have told me that sooner?
There have been several. Obviously, as Conley mentioned, no one wants to read every word of every loan document they sign, but there's some pretty important stuff there. And there typically are covenants, obviously requirements to provide financial statements on a regular basis that should keep some communication going back and forth. Taking on a partners, ceasing operations, relocating, a lot of those simple decisions you make every day, right, that do impact loan covenants. In a practical way, because we are a consumer lender as well as business lender, someone who, a year or two into a commercial relationship says, oh yeah, I just bought a house, I got a mortgage through someone else, or, down the street, or I went online and found a mortgage or found a business lender for something else. And like, you didn't even ask, we could have done that for you, kept it here locally. We're very community involved and try to be, as committed to our communities as we can be. So just asking first. A lot of, through COVID, a lot of businesses saw short-term cash flow crunches and looked for quick fixes. A lot of that in the fintech or merchant advance and small loans that look like a great deal on the front end, but then you realize you're repaying it, and all of a sudden it really hurts your cash flow even more. So just being proactive, letting us know whether things are going well or not. That if we can get ahead of a problem that you see coming, that's half the battle.
Yeah, great. Matt, Connolly and Scott both mentioned covenants on the loans, and those of us in the business understand what those are and how that does actually drive communication beyond the loan. Can you explain just briefly what is a covenant and what are some of the things that are in those covenants that drive this communication, Matt?
Sure, good question.
Using no jargon at all, by the way.
Yeah.
One thing about the 7A program is they don't allow us to really have many covenants on our loan. Our main covenant is you make the payment, on the due date, and that you provide your financial. That's another reason your banker will reach out to you and say, hey, we haven't seen your financials in the last year. We need to get those updated. So those are the two main things from a 7A standpoint. But traditionally you see covenants on like debt service coverages, right? So a debt service coverage is where if you've got so much in revenues minus your expenses, you have enough cash left over to service your debt. And if you have a one-time coverage, that means you have just enough excess cash to cover your debt obligations. So most banks want to see a debt service coverage of 1.25 times. So that means you've got 0.25% left over after you've done all your obligations to kind of cover various expenses. So that's one thing your banker, if you've got that coming in there, is going to look at your financials and say, hey, you had a rough year, you kind of dropped down, below 1.25, you're at 1.05. What was going on there? And it gives them some flexibility to kind of work with you. In extreme cases, I guess they could actually call the note if you didn't meet that covenant. That's probably the biggest one I see. Taking on too much debt, having to do with the balance sheet, where you've got too much debt to net worth. Maybe you have a covenant saying, hey, the bank won't allow you to take on additional loans unless you get the bank's permission to do that. Those are kind of some I've seen in the past. Obviously not all of them, but as I've seen.
Yep. So Paul, in the last minute that we have here, what are some of the things that as an investor, you're wanting these small business owners to communicate back to you? Obviously you're holding an ownership stake, so you probably have a good pulse on what's going on, we would think, but what are some things that you're hoping that get communicated?
Honestly, I think we just want to know everything that's going on. So I wouldn't say there's subjects that we specifically focus on, but it's more techniques. Just communicate frequently, openly, transparently, kind of proactively. Keep us up to date if things are going well, but also keep us up to date when things aren't going well, because there'll come a time when you probably need more money. And if we're well up to speed on what's happening and you've been good at communicating with us, then that can happen much more easily than if we find out, suddenly you're out of money and we didn't know about that, and you can't make payroll next week. So just proactive and frequent communication, good and bad, we will take all of it.
All right. Well, thank you all for your input on the questions that we've had today. You guys have done a great job. If there are any additional questions that folks would like to drop into the chat, certainly do that. We can get back, we can circle back around to you on those as we close out today if you think of something.
And Earl,
Mm-hmm.
I just want to just one thing that just listening to the panel here today, y'all use the words trust and partner a lot. So as a potential borrower, are you saying that we should just approach all conversations with you know, that we can trust you, that you're our partner, as opposed to any other kind of maybe other type attitude?
I would say yes. To me, it's just having a conversation and being open and as direct as you can. Don't approach it as like, I've got to convince someone of something. That's definitely not what we're looking for. Because at the end, if you convince us of something, it's not right. It's not going to be good for the small business owner or the bank. And no, it just be upfront and just ask questions to get to know the process. But don't look at it as, I say, a sales pitch. To me, that's not what it's supposed to be.
I think too, going on with that is don't have your lender or the person you're hoping to borrow money from keep having to dig in and ask questions so much and so much and so much. There are issues that you need to disclose, such as like a bankruptcy or some poor credit payments or something going on. Don't surprise your lender once they do a deep dive. It's called a LexisNexis, which is a deep dive kind of credit report on you. And things come up from that you would be, go ahead, just say, go ahead and bring it out. They're not going to judge you for it. You just need to know, because if it's an issue that needs to be dealt with, especially on the SBA side of the shop, and they know how to do that. So yeah, I think it is a lot of trust back and forth, and know too that what you're telling your potential lender is confidential as well. It's not going anywhere other than strictly a business transaction there.
And kind of piggybacking on what Conley said, a lot of times you would think borrowers would know what maybe some possible hurdles are going to be. And if they kind of tell you that on the first conversation early on, it's going to just gain trust from the lender that, okay, this person's trying to kind of get this process moving, but letting me be aware of what could be some issues we have to overcome versus me finding them, you know, a month down the process. That will really help build trust.
One thing I will add to that is, we work with all these clients, and we're obviously not a lender, but we get the other end of the conversation after they leave the lender many times. And it's unfortunate that many small businesses equate the word trust with the word yes, meaning if they said yes to my loan request, then I trust them, they trust me. But if they ever say no, I can't trust them anymore. The fact of the matter is, they're probably much more trustworthy if they've told you no when you needed to know. So don't always equate the smooth road with trust. You have to get that tough love sometimes too, right? So
And I guess, Earl, lenders and investors, they only make money if they lend and invest.
that's correct.
And if they make a wise decision by partnering with trusting partners. So
Yeah.
Right. If you get a no, they're probably doing you a favor.
Right. And that's what we do. We rent money. So we rent money, we won't get that money back. So we rent it out to somebody else. That's really what we're doing there. And if you do get a no from a lender, try to dig in and find out why you got a no. So if you want to go forward down the road, what do you need to do to be able to get a potential yes one day?
Yep. And that's continuing the conversation, right? So
Absolutely.
So with that, we'll move in to close out our session today. Some of the things that you might want to consider as next steps, certainly reach out to the SBDC, the Women's Business Center, SCORE, any of the panelists that we've had on the panel today. Make sure that if you've got a question, you get that answered. If you walk around with a question and you never reach out to get an answer to it, that's on you. If you reach out to us and we don't answer it, then that's on us. So please put those questions in front of us. Make sure you get your financial house in order. I think it's been driven home through today's presentation that the numbers are extremely important, no matter who you're approaching, micro lending, investor, 7A, 504, whatever the program is, you have to have your numbers in order. And then we do encourage you to benchmark your business on a regular basis. That was kind of touched upon when we talked about covenants today. You do have to make sure that the business is performing as best as it can. And certainly all of the partners that are on the call today are equipped to do that. So do reach out to us if you haven't benchmarked your business lately. We would be more than happy to help you with that. So with that, I will turn it over to Aaron, who has a couple of closing remarks, and we'll leave the contact information up on the screen while Aaron takes it away and closes us out.
All right, very good, Earl. Thank you, and thanks to all of our panelists. It was very interesting, and Thanks for the questions for all the people who attended. A few housekeeping items. Justine Allen will be sending a follow-up email to everyone who registered for this workshop. So, and as well as those who attended, so that they will receive a copy of this recording. So you can not only watch it now, but in the future. And then the other thing is that when we all got together, meaning Earl, Anna, Jerry, and I, to talk about how can we bring additional training to our business owners, we also looked at the existing programming. And we realized that a lot of the existing programming is very specific and deep dive. And so you will see, if I share my, so you will see that in the chat, there is a link to startgrowupstate.com. That Start Grow Upstate, let me see if I can share, here we go. That startgrowupstate.com is a business resource that has a calendar on it. Let me move all of y'all out of the way. And if you click on events, you will see quite a few events in our Upstate, one of which is this How to Pitch, which is put on by Venture South. And they go through the types of information that they're looking for. You will also see that there are other programs such as, Start Small Business, Defining Your Vision, Business Model Canvas, that's a SCORE program. So there are all kinds of very deeper, much more narrower topics that are available on the startgrowupstate.com/explore-events website. So thanks, y'all. And we will see you in 2 weeks for the SCORE program, which will be on difficult conversations around selling and talking to your customers. So Jerry, we're looking forward to that. Thanks, everybody.
Thank you.